Hey everyone, I'm Nihala Nazeer. I'm an ACCA finalist. So, today we are going to continue where we left off from P1 of CIMA of the first chapter. So, where we left off was the two methods of costing. One is the absorption costing, and the other was the marginal costing. See, based on the discretion of the cost accountant, he may choose whichever costing method he finds suitable for his company. Or on the command of the management, he can choose whichever methods he seem plausible for the accounting. So, while he do this, there are different types of pricing strategy he uses. The pricing strategy depends upon the cost, the competitors, the customers, the corporate objectives, etc. So, while you determine a price, there are different methods. The first method is full cost plus pricing. Under this method, the cost is determined by using absorption costing, where an accountant or a cost accountant finds all the costs that is incurred on the product. Okay, then he marks the cost up to a certain percentage, whichever the percentage is plausible for the company. Then the selling price is going to be full cost that's been calculated into 1 plus whatever the markup percentage is found. The markup percentage is always in decimals, or you can together you can do like 100 plus the percentage, or this one is a bit easier than what when you show them in percentage. The second one is marginal cost plus pricing. Under this method, the accountant finds the cost using marginal costing method, where he excludes the fixed cost of the product. So, under this, the selling price is going to be marginal cost, whatever he has calculated, into 1 plus whatever markup percentage the company has to follow. The third one is target return on capital. Here, what the organization or the management decides is that they need something or some sort of return for whatever they have invested in the company. Say, the company has invested $1 million. Then they expect 25% of that $1 million in return. This is the targeted return on investment in the product or budgeted level of production. So, whatever the company has invested in the level of production, the company expects a certain percentage in return. Here, the profit markup is equal to targeted return on investment in the product or budgeted level of production. The next one is the profit margin. sometimes the examiner may give you a selling price or give you something excluding the profit margin as an alternative calculation. So you must find the selling price or anything that is required to find by using profit margin. Here the selling price is equal to total cost divided by 1 minus required margin. Now, there's a small tip. I guess many have covered that tip along your years of studying professional course. The tip is that whenever the word margin is there, we have to take the selling price as 100. And whenever there is a term markup, then we have to take the cost as 100. Here the 100 is the percentage, or as an alternative, instead of taking the percentage, you take the decimal and the 100 becomes 1 in both scenarios. Thank you. That's all for today. See you next time.